The Nationals? I'm like, come on.
Well, I did live in DC for a long time.
Okay.
Plus, it's a school fellowship.
Oh, I'll grant you that.
It's red. Wednesday, so.
Oh, that's right. I actually have saved all my school clothes for tomorrow, Friday, Saturday. So I only have so much St. Martin's stuff that I'm allowed to wear because if we're teaching, we're supposed to wear a collared shirt. And so we've got a slight, tiny little dress code.
Yeah, I've got 3 colored shirts. I'm not going to work today. So.
Yeah, I'm in the, I have 3 or 4 athletics, State's athletic shirts. But I forgot.
First time I've ever seen the same class for the beginning of the year.
Did they have something?
I tried to, but they said no, you can have it.
Okay, I'm going to get started because we've got a lot to cover. I'm going to give a couple general housekeeping announcements here at the beginning, a recommendation, and then we'll dive into what's left of Chapter 8. So as you're probably aware, especially those of you who have started your midterm, it covers Chapter 8. So I tried to move expeditiously through to a problem last time to kind of show you how stuff sets up. I'm going to try and move expeditiously today because, as you probably recall from last class, those of you who were here, there will be no class on Friday. So you get a little early start on your spring break. Now, the quiz for Chapter 8 is not due until the 30th. So you'll find it.
I thought it's Chapter 9 is next. We don't have a Chapter 8.
That's interesting. Because I thought, you said that, but I looked this morning and it said Chapter 8. So I was like, oh, well.
Where's the Chapter 9?
Quiz 8 on Chapter 9?
Chapter 9.
Oh, gosh, darn it.
That's why,
If you want to take one, I can give you one.
we're okay.
You'll take 3 points. Okay, well, we'll give 3 points then. So I will not do I miscounted and I got an email from Leslie last night. I looked this morning and said, oh, no, it's in there. I put it in there. And I'm like, oh, I apparently have not. So what am I going to, I'm not going to do it.
It was there at one point. You're not.
No, who wants a Chapter 8 quiz?
My 3 points.
It's only 3 points if you do it right.
Well, how hard is it to do it right?
So here's how my,
Sisters, shush.
could it be a 10-question quiz? Yes, I can put up a 10-question
Whoa, I
quiz.
thought we had.
You had no quiz. So here's
How about extra credit?
extra credit. You like the extra credit?
Yeah.
Extra credit. There you go. So we'll do it. I'll pop one up right after class. Of a 25 question extra credit. You got big enough
Choice to do it.
sample size.
I got you.
A 25 question extra credit. I'll make it through the 30th. So, but it'll be open right away. So if you want to do it, you can. If you don't want to do it, don't worry about it. And I will count it for an extra credit. Probably, I'll call it. We'll see how things go. Probably 10 points. Equivalent of 10 points on the midterm.
Oh, fuck. We were gonna get homework.
So it'll be whatever you get on there multiplied by 0.1 added to your midterm. Well, so we're making decisions on the fly. I don't know how that's going to screw. I don't know how that's going to screw up my curve, but that's okay. We'll make decisions on the fly. So I'll put a chapter 8 quiz up, make it due the 30th. It'll be worth 10 points on the midterm. I'll multiply the score you get on the quiz, the highest score you get on the quiz by 0.1, add those points to your midterm grade. You can get over 100 on the midterm. So let me give a little heads up for those of you who haven't started the midterms yet. It is lengthy. And so I would be kind of whittling away at this thing. You get 2 shots at it if you want them. For my last 2 sections that I've taught of BA 300, the average score on the midterm, which was similar in size and scope, although the last section was chapters 1 through 10, not chapters 1 through 8, was about 82 or 83.
That was average.
That was the average, which with scores ranging from 72 to 100. So you've got kind of the average as well as the range. It's the hardest part about the midterm is it's a long midterm. So if I were you guys, because you don't have class on Friday, I would take that hour and work on the midterm and start knocking it out. The classroom will be open. You can come in here if you want to come in here and work on it. Work on it in your room. You can work on it at home if you manage to be able to sneak out of here early on Friday. That's your call. But I would start working on it, because if you wait until the end of your spring break to do the midterm and say, okay, I'm going to do it the day before, you're going to have one lousy spring break, because it is probably, depending on how quickly you move through this stuff, it could be 3 or 4 hours of work. Yes, ma'am.
It's due the week after, right?
Correct.
Okay.
Correct.
But yeah, you don't want to do it all during the week right up school.
No, because if you wait until you get back, and then you've got all your classes on top of a 4-hour midterm, it's going to be hellish. So I'd get started already, and I'd start working my way through it, knowing you got 2 shots at it. I would kind of ease my way into it. I take my time. It counts for a pretty substantial portion of the grade. There's not a ton of chapter 8 stuff on there. Most of what you're going to find are the things that we talked about last class, calculating standard deviation, and then talking about this here nifty concept of covariance and coefficient of variation. So we're going to look at a couple different pieces. Well, I haven't graded, so my GBLM I haven't graded yet, but I'm expecting a Y distribution based upon my review of the papers that were coming in. So I have a couple students in there who have been spot on the entire class, running 96, 97 averages, and they're gonna, and it looked like they did fairly well on the final. And I have other folks who've been kind of half-assing it through the class, and their finals the final's hard.
What? For this class?
For this class, final's hard. The final is not an online final. The final is difficult because it's a practical application, but I've been saying that right along. It's practical application of financial analysis. You'll have plenty of time to do it. And I may scope it back depending on how long they give me for your final exam, but it's a difficult final. Any questions on this week, on chapter 8, on the midterm, on the now extra credit quiz for chapter 8, which will be opened and added today? Okay. So let's dive into moving through as much as we can, as fast as we can, because of course we've got spring break and no class on Friday. I want to talk about the coefficient of variation, because this is what allows you, and we had the question last class, well, how do you figure out which one, whether it's this one or this one? And if I've got a choice between 2 things that are risky
and there are different risks and different returns. How do I kind of make a decision which one to pick? And amazingly enough, that's a really good question that has a mathematical answer. The mathematical answer is this concept of coefficient of variation. And you're going to be asked to calculate coefficient of variation. And so it's important to kind of get a perspective on how this works. So with coefficient of variation, we're looking at two different assets or two different elements with both risk and return. So you're saying, okay, I've got a choice. I got $100,000. I could buy an apartment building, or I can buy $100,000 worth of IBM stock. What do I choose? And you're like, I don't really know, because they're different risks, different return, different asset. What this does is level sets that and quantifies and gives you a variable, or excuse me, a coefficient that says, here's the risk of different things. So if you take the risk, which is what? Standard deviation. If you take the standard deviation and you put it over the expected return, you'll come up with a coefficient of variation. And essentially what you're looking for is a situation where you've got the lowest coefficient of variation. Essentially, you've got the lowest risk for the highest return. So, you know, this is 3% and this is 10%, versus this is 10% and this is 12%. You can see that the lower this is, that will rank higher. So this is just a tool by which you can measure two different assets with different risks, different returns, put them on kind of the same playing field and go, given that, which one is a preferred investment, or at least preferred relative to risk and return. It's a simple, it's simple math. The concept of risk is generally, we are risk averse. As an investor, generally you are risk averse. There are some people who are at a higher risk tolerance, but anyone who's logical wants the most they can get for the least amount of risk. And so risk aversion essentially is going, look, I want the most I can get for the least amount of risk, and if you're going to make me take risk, I want to be compensated for that. Now there's some folks, and I will call them perhaps non-normal, who just take risk as a thrill. They gamble. They don't take into effect risk and return, because the expected return is low, the risk is high, and they get a psychological benefit from their investment activity, buying lottery tickets, versus the logic of investment. If you're investing, there's an inverse relationship between, or there's a correlated relationship between risk and return. The higher the risk, the higher the return. And most of us want to have as much as we can get in return with as little risk as possible, and that's risk aversion. When we look at risk aversion, you then go, okay, so how much? And so some of these questions came up last class. Okay, how much? How do I kind of figure out what my risk aversion is, and how much more return do I need to get to take on some additional risk? And that's the risk premium. And a risk premium essentially is a calculation that says this particular investment has an expected return on it. There's a portion of that that is attributed, that is what we'll call risk-free. And we're starting to move again back into this concept called the capital asset pricing model, which I get really excited about because it's a cool calculation and it kind of brings all the risk stuff into focus. And so the difference between risk-free and how much of a return we need given a specific risk profile is a risk premium. And that risk premium is calculable. And so we can come up with an equation, and we're going to look at that equation, which basically says, given a certain level of risk, I need a return of X in order to take that on. And it's not necessarily linear, but I need if I'm going to take on twice as much risk, I want additional return. And how much additional return is that going to be? And so we're going to look at that. It's it's linear once you pass the y-intercept. And so we're going to look at it graphically as well. You have two pieces, and as you guys know, I like graphs. They make things kind of come to life for me. So you've got these two pieces of the risk premium. If you got something with zero risk, so this is below average, and this is zero, so zero risk. Your return is the risk-free rate. So you'll see this, and this is a common term that you'll see not just here, but almost everywhere, R sub RF, the risk-free rate. The risk-free rate takes into account a couple pieces of information. It takes into account your real required rate of return and the inflation premium. So if you're looking at a government bond that's going to pay you back over a certain period of time, you've got a real required rate of return and an inflation premium. But you don't have default risk, you don't have liquidity risk, you don't have any of those others. You don't have the other associated risks of non-payment or delayed payment. You really only have the factors that drive return from the market. So you got this risk-free rate, which is essentially your real rate required plus inflation, because the government doesn't control inflation, but a government bond is essentially a risk-free bond. U.S. government bond, for all intents and purposes. And then you see this as the risk line. And the difference between the risk-free rate and the required rate of return at any given point is the risk premium. And that risk premium comprises a bunch of components like default risk, like liquidity risk. Pretty much anything else you can think of that might cause you to question whether you want to buy that bond or you want to buy that asset is factored into this risk premium. And the risk tolerance is the slope. And so you really have this ability where if you're highly risk tolerant, the slope might be relatively low. You go, okay, I'll take, for a high risk asset, and I've got a high risk tolerance and I've got a low slope, I might be able to take a relatively low required rate of return. If I've got a high risk tolerance or a high risk free, or excuse me, this would be a high risk tolerance. If I have a low risk tolerance, this slope might be significantly higher because in order to take on even below average risk, I might need an average rate of return. So the slope of this is driven by your risk tolerance. The area under this is driven by the risk premium, and then you got this risk-free rate. The risk-free rate is, like we talked about earlier in the semester, you can look that up. For any given point in time, you can look up what the risk-free rate is, because this concept is so pervasive in finance that this gets tracked. So you could say for a 2-year asset, what's the risk-free rate on a 2-year asset? And you can look that up, and it changes daily based upon things like expected inflation. Any questions on that concept of risk premium before I go to a portfolio return? Again, I'm front loading some of the math because you're going to see some of the math. Portfolio return is a simple concept. Essentially, you're taking, this is the required rate of return on a portfolio, or expected return on a portfolio. You're just multiplying it by each, if you think of these as securities or assets, you're multiplying the weight of that asset in the portfolio by the expected return in that portfolio. And the sum of the weights are going to equal 100, just like they did when we looked at probability distributions, when we looked at standard deviation. You have to, these weights have to equal 100, and your expected return on each asset is whatever it's calculated out to be. And all you do is sum those up. And that's what this equation is from 1 to n, where n is the number of assets within the portfolio. You just run through this equation, bang, 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 it's a weighted average. Is there anybody who has, let me phrase this differently. If anyone has questions on how to calculate things like weighted average, or the standard deviation or things like that, set up a time with me to go through it. This isn't difficult math, but sometimes it is difficult to kind of grab the concept. So just let me know. This concept of realized rate of return, you tend not to see, I've never seen outside of this book, this R umlaut thing. If you took German, you'll know what I'm talking about. That R with two dots above it is a realized rate of return. I've never seen that anywhere else. That's a book concept. It's a concept you'll see because the quizzes are online. You'll see it there. That's the actual rate of return. You're always going to see some variation between what you expect and what you actually get, unless you're really good or you have a zero risk asset. If you're really good and you're consistently able to make sure that your realized return is equal to your expected return, please come see me, because I'd like to use you for some of our work here at the university. We calculate correlation coefficient. Correlation coefficient is really looking at assets, two or more different assets, and seeing how they operate in relationship to each other. And let me give the classic example of, you've got this high-tech company, Apple, and you've got a high-tech company, Amazon. They probably operate, if the market's going up and down, they probably operate very similarly. They go up together, they go down together. When you diversify a portfolio, so we're starting to talk portfolio theory and portfolio risk. And one of the things that you'll talk about, or we'll talk about, is diversification. And how do you reduce risk? How do you get the maximum return and reduce risk? And one of the ways you do that is you have assets that don't do exactly the same thing. So when this asset goes down, this one goes up. When this asset goes up, this one goes down. And so they're negatively correlated. Essentially, you've got stocks that move in opposite directions. So you may have a stock, you may have an automaker and a steel producer. When the price of steel goes up, the price of cars goes up, their sales go down. So when a steel producer's stock rises, generally an automaker's stock is going to fall because it's a cost of an input. So these guys are making more profit. That profit is usually at the expense of who's using their inputs, which is going to be a car maker. So you can think about those as potentially negatively correlated. A positively correlated stock means you amplify. So those two stocks are going to move in parallel. And when we're building a portfolio, and when we're looking at, from an investment theory perspective, you want a well-diversified portfolio. And a well-diversified portfolio means you're looking at stocks where essentially you're able to have a combination of negatively correlated stocks so that your expected returns are realized, because if this one goes up, this one goes down, this one goes down, this one goes up, they end up performing as expected. If they positively correlate, you'll tend to see an amplification of return, and you end up with additional portfolio risk built into your pool. And this really summarizes that well. To reduce risk in a portfolio. And a portfolio, for our purpose, is nothing more than a group of assets. We tend to think about portfolios, if you're in the investment world, as stocks. It's a bunch of stocks. We put stocks together and it's a portfolio. But more broadly in finance theory, a portfolio is any grouping of assets. You yourself have a portfolio. Your portfolio right now may consist of things like, I've got a savings account, a checking account. I've got assets like an apartment or furniture. And I've got other financial assets, retirement accounts. I've got student loans that I'm taking on for which I expect a rate of return, because this investment should pay off over time. You yourself are an asset. And you look at how you're expending that money and how you're balancing that out. You go, okay, that's a portfolio of assets. If you're, after you get out of school and you end up kind of establishing yourself, you're going to have retirement funds, you're going to have houses, you're going to have investments, you're going to have potentially debt and real estate investments, and all that is a portfolio. And what you're looking for is trying to determine, how do I combine, and this is stocks, but really it's assets that are not perfectly correlated so that you can have a diversified portfolio. So gold, for instance, is not perfectly correlated with the stock market. Rental real estate is not perfectly correlated with the bond market. And so putting those together will give you a well-diversified investment portfolio for yourself. And if you're looking at stocks, which is where we're going to narrow it to in this class, you want a well-diversified portfolio as well, so you don't have amplification of return, amplification of risk. The riskiness of a portfolio is reduced by the number, the more stock that's in there, the more different types of assets that are in there, the lower the risk is. Why? Yeah, diversification. So when you go back to this concept of weighted average return, or expected return, and the portfolio return is a weighted average. If the weighting is 1, your entire portfolio is in this one asset. That's pretty risky. Whatever that asset does is what the portfolio does. But if you have 200 different stocks or bonds in there, even if one went to 0, it's really not going to have a significant impact on the overall expected return of the portfolio because it's just a small piece. And so if you had every stock in the world in your portfolio at a weighting that's equivalent to their market weighting, your portfolio would perform exactly the same way the market does. And so if some companies go bankrupt and some companies go to the moon, and all of that risk would be reduced to, I've just got market risk. And so the more stocks you have in a portfolio, the more assets you have in a portfolio, the less risk you have. If you have one house and it's a rental house and it's vacant, that's risky. If you have 10 rental houses and one's vacant, it's less risky. So you want to have a higher number, ideally, of securities. There's a point at which, and again, if you are a finance major and you go on into study investment theory, there's a point of diminishing return. So each time you buy an asset, it costs you money. It costs you money to manage each asset. So, if I said, well, you could have the entire universe of stocks in your portfolio, and you're like, well, how am I going to do that? I got to buy Vietnamese stocks. I got to buy Bangladeshi stocks. I got to buy U.S. stocks. I got to buy all these stocks. I got to put all this stuff together. How do I build that portfolio? It costs money. There's a diminishing return as you begin to add stocks to a portfolio to where the next additional stock that you add into that portfolio doesn't do much for the actual diversification of the portfolio. And that break point has traditionally been between 15 and 20. So you don't need hundreds or even thousands. You don't even need dozens. It's normally around 15 to 20 stocks, well-diversified and non-correlated, will give you a well-diversified portfolio. You're going to be very close at that point to near perfect diversification without having tons and tons and tons and tons of other stocks and having tons and tons of assets. While it sounds cool, is expensive to both transact as well as manage. All of the positive correlation, so the smaller things, the correlation of this goes up, so this goes up, the lower the risk. The greater the negative correlation, so this goes up, this goes down, the lower the risk. Our goal is to have, ideally, a return, expected return here, and a risk level that's lower because it's been diversified away. Because that individual risk associated with that individual company has been diversified away because you've got a bunch of other companies that'll offset if something goes really bad. Now, the offside of that is if something goes really good, you've probably offset that too. But remember, risk is standard deviation, both sides of both tails, good and bad. And what we're trying to do is get the highest expected return for the lowest amount of risk, for the lowest standard deviation. So We're saying we're willing to accept lower upside and lower downside as long as we hit that expected return and our standard deviation is low. And in order to do that, you utilize the correlation of the two. You offset that correlation. It reduces the volatility, reduces the standard deviation, and drives risk down. Any questions on this concept? So here's a graph. So I like graphs. It basically just shows what I discussed. Portfolio risk is here on this axis, and this is the number of stocks. You get into this point, right around a dozen, 15. You see that the diversifiable risk, the risk that's associated with the underlying stocks versus the market, starts to really flatten out and minimize. You get out here, where you've got all New York Stock Exchange stocks, you're matching the market. At 40, if they're well diversified, you're basically right there. Even at 20, you've taken most of the volatility. You know, if you've got a standard deviation with one stock of 30% nearly, you've dropped that, and at fully diversified, your standard deviation is 15, you're down around 17 or 16 with just 20 stocks. And so you don't need a ton of diversity of different assets to get rid of a big chunk of the volatility. A little bit of diversification goes a long way to reducing risk. And this is, it's easy to see here graphically far more than me either talking about it or throwing up equations over and over again to look at it. There's a few things in the risk side that you're not going to be compensated for. The market, and we're going to talk market efficiency in the class, not this one, but in the semester. The market is deemed to be efficient. We say, look, you got thousands or even millions of people investing in the market, and they're all looking at information. And if you just think about Wall Street, and there's tens of thousands of people working on Wall Street, and they're looking at all these companies, they're analyzing the portfolios, or they're analyzing the stocks, and they're analyzing the bonds, and they're providing all this information. The market's pretty efficient. Folks are looking at everything you're learning. Folks are doing it every day. There's folks making big bucks that just sit there and crunch through companies and analyze them for their normal job, their day job. And so essentially what Finance Theory says is you're not going to be compensated for taking on this additional risk associated with company X, Y, or Z. Finance Theory says all that information that's part of that company is already known and priced into the stock, because the price of the stock is the expected future value of the cash flows discounted at a discount rate. And the market, a bunch of people have looked at it and modeled out what the expected future cash flows are. They've modeled out the risk profile associated with the discount rate. And so that stock is efficiently priced. That's an assumption. And therefore, you're not going to be overly compensated for taking out more risk for that one stock. And so there's this component called firm-specific risk. Basically, the risk associated with owning just one stock, or with owning stock in just one company. And that's the risk associated by having something happen to that company specifically. You own Apple and Steve Jobs dies. That's a risk. You have a well-diversified portfolio. If you have 200 tech stocks and Steve Jobs dies, it's sad, but it doesn't trigger your portfolio. If you have a portfolio and Steve Jobs dies and the only stock you own is Apple, that could be a problem. Or now, the one that needs to be on the radar, I think, for some folks is Berkshire Hathaway and Warren Buffett dies. Or Amazon and Jeff Bezos dies. Or anything else is specific to that company, and I use those examples because it's easy to picture. If it's unique to that company, it's firm-specific risk. You eliminate it through diversification. Like I said, if you had 200 companies and Apple is 0.5% of your portfolio, something bad happens to Apple, it goes down 30%, your portfolio hardly takes a blip. But if it's your entire portfolio, you take the full hit. Yes, ma'am.
When you're talking about a portfolio, are you saying like a company's portfolio or like individual stockholders' portfolio?
Let's call it an individual stockholder portfolio. The same, although to your point, the same issue applies when you're looking at within the firm at I can do these projects, or I can invest in these assets, or I can invest in these products. The same philosophy or the same theory applies there. And so again, we use stocks and bonds because they tend to be easier to kind of get our head around. As we move through the class and we get into capital budgeting, you'll see that this is the same. This concept of diversification of risk, return, and expectation apply not only to stocks, bonds, and securities, but to any financial asset or any financial project. So this is kind of a universal. But for this purpose, so you're dead on, but for this purpose, we're focused on stocks and bonds, and then you can think about it as an individual investment. And this is what I tend to call it is unsystematic risk. It's essentially risk that is outside the system being the market. So you don't get compensated, you don't get additional return for taking on unsystematic risk. The expected return is still X, the risk is high, and you're not being adequately compensated for it by definition. The other piece of risk is market risk. Market risk is anything that's going to happen in the market that you can't diversify away. Systematic risk. Somebody in Washington and somebody in Pyongyang decides that they're going to get into a discussion around their nuclear weapons buttons, and the market goes down. That's systematic risk. You can't diversify that away. You have a situation where there's a price shock on oil. Arguably, you can diversify some of that away. But go with me for a minute. You got a price shock on oil. It impacts the entire U.S. economy. You're invested in U.S. stocks. Tough to diversify that away. The argument there would be you should be diversified globally. A portion of your stocks should be internationally invested. So if the U.S. economy craters, you diversify it into other markets. And so that helps and are negatively correlated and help offset. But essentially, if you can't diversify it away because it's not firm specific and it's driven by economic or other market factors, that's systematic risk. That means the whole market is kind of going up and down. The 2008 financial crisis would be an example of something that's kind of a systematic risk. The whole system got sick. It impacted stocks, it impacted bonds, it impacted other financial assets, real estate and other things. And that was the market risk. You can't diversify, and again, we're using absolutes, you can't diversify market risk away. However, you can diversify the markets. And so then you start looking at international markets versus different asset classes. The relevant risk is market risk. The risk that's associated that can't be diversified away. And again, we talk absolutes, but there's few absolutes. And a risk reflects a security's contribution to the total risk in a portfolio. Essentially, if you can't diversify away that risk then enters your portfolio. The risk associated with that security is in your portfolio, and it's what you're going to have to measure. Irrelevant risk, uncompensated risk is generally how you'll hear me refer to it, is firm specific. You don't get compensated for it. It's risk associated with a security that can be diversified away. And so if it can be diversified away, and you can get rid of that risk, you're not going to get compensated for that risk. The return's not going to be higher because you can make a bunch of that risk go away. So the risk might be, a 30, standard deviation of 30. The expected return is still a 10. If you buy 10 stocks and you put them together, when you looked at that last chart, your expected return might still be 10, but the standard deviation is now down around 12 or 15 or 17. And so you've essentially eliminated a bunch of risk, haven't changed your return at all. You're not being compensated for taking a bunch of firm-specific risk. And as a result, Finance Series says we are looking for a well-diversified portfolio of assets. We want to diversify away all the risk that we're not getting paid for. If the expected return isn't going up and we're taking on more risk, that's illogical. And so because we're finance people and we're logical and we're math oriented, we don't take on firm specific risk. We diversify it away. And when you diversify it away, now you've got this portfolio of assets that look like the market or close to the market. And then we can start looking at, okay, if we diversified the firm-specific asset stuff away, now we've got a pool of stocks: Amazon, Apple, IBM, Western Digital. It doesn't matter. Put a bunch of these tech stocks in there and go, okay, here's a bunch of tech stocks. These tech stocks, if they're diversified away, when we look at the whole market, and we assume that firm-specific risk has been diversified away, these stocks still move. Some of them move a little bit more than the market. Some of them move a little bit less than the market. So the market goes up 10%. Maybe Amazon goes up 12%. When the market goes down 10%, maybe Amazon goes down 12%. But that's looking at the whole market. We've kind of removed out the noise of Amazon. Jeff Bezos launched the Kindle Fire or the drone delivery, and it didn't work. That's firm specific. But when we look at how Amazon has performed over time, and we say, well, it goes up a little bit more than the market and down a little bit more than the market, it's more volatile than the market. For any given stock, you can calculate this nifty thing called beta. And beta essentially says, look, the market goes up, the market goes down, and we can track that. Whether it's the S&P 500 index, whether it's the New York Stock Exchange index, doesn't matter what index we use, we can see that the market goes up and down. So when people talk about the market's going up, generally it might be the Dow Jones Industrial Index, or it might be the S&P, it's going up, it's going down. We can measure that. And we can look over time at what any given stock has done relative to when the market's gone up and the market's gone down. And we can look over a period of years, hundreds or thousands of days of performance. And we look at when the stock goes up and then when the stock goes down, and when the market goes up and when the market goes down, and figure out how they're correlated. And then we calculate this concept of beta. Beta is nothing more than how much of an amplification or dampening effect that stock has relative to the market. I'll give a couple examples. If a stock moves exactly the same way as the market does, market goes up 10%, stock goes down 10%. On average, over 5 years, stock goes up 10%, market goes up 10%. They move in tandem. The beta is going to be 1. That market, or the market and that stock, essentially perform identically. We're darn close. It's not going to be that way every day because there's still firm-specific risk in there. There's firm-specific risk in there. And so you're going to see some deviation. But in general, it performs the same way as the market. That's a beta of 1. The example I just gave with Amazon, where the market goes up by 10%, Amazon goes up by 12%. Market goes down by 10%, Amazon goes down by 12%. What's that beta? 1.2. Amazon, when the market moves, Amazon moves 120% more than the market, up or down. if you have the market goes up 10% and US Electric goes up by 7%, or the market goes down by 10% and US Electric goes down by 7%, what's the beta? 0.7. So the entire market has a beta of what? So if I look at the whole market, the beta is equal to 1. Because the market return is the market return. Any given stock has a beta. And that beta is calculated over a long period of time, comparing the returns of the stock, the price of the stock to the price of the market. They calculate this beta, and it essentially is as simple as when the market goes, the easy way for me, the market goes up 10%, the stock goes up by how much? It's a beta of 1.2, it goes up by 12%. If it's a beta of 0.7, it goes up by 7%. And so it shows how much of an impact systematic risk has on the market or on that specific stock over time, on average. And there it is on the screen. Betas over 2 are pretty rare. Betas under 0.5 are pretty rare. However, there are some stocks that have negative beta. The market goes up and the stock goes down. Those stocks are pretty nifty because when you think about trying to find stocks that are negatively correlated, those stocks are negatively correlated with the market. So when the market's crashing, those stocks are going to actually be rising. In theory, over a long period of time, the longitudinal data says that the beta would be negative and that they would rise. When you're looking at a portfolio beta, the portfolio beta, and all portfolios have a beta, is the weighted average beta of each security within a portfolio. So like I said, if you have problems with weighted average, see me, because we're going to use weighted average a lot in portfolio theory. And so when you've got a portfolio beta, it's essentially weighted average of all the betas in the portfolio. Our goal is to get the highest expected return for the lowest possible beta. Essentially, what you're looking for at that point is you're back to the coefficient of variation, where you're going, okay, I want the highest return, lowest volatility, and beta is volatility. So you want the highest return and the lowest possible beta. A beta of 1 is equal to the market. If you can get an expected return higher than the market return and a beta of 1, you're ahead. And I'm going to leave it with CAPM. And we're going to come back a week from Monday, and we're going to spend some time on CAPM. CAPM is my favorite thing, because it summarizes all this cool risk stuff. The risk premium for a stock, or for any given financial asset, is a factor of these things. It's a factor of the market risk minus the risk-free rate, because the risk-free rate is what it is. If you're investing in risk-free securities, you're going to get the risk-free rate, times the beta. So the average, so in this particular case, the risk premium for a stock is the market risk for that in that particular market minus the risk-free rate times the beta for that stock. You don't get compensated on beta, so if it's 1.2, you don't get compensated for risk-free because there's no risk, and you don't get compensated for firm-specific risk. You don't see firm-specific risk in here. It's just the market risk. You don't get compensated for firm-specific risk. The expected return, the risk premium, is driven by beta, the market, and risk-free. How volatile is that stock relative to the market? What's the risk-free rate at that point in time? Because if risk-free rate changes, the risk premium changes. And what's the expected return, required return on that market? And if that changes, the required return changes as well. Any questions? Enjoy your extended break. For all of you who can, enjoy the basketball games this weekend. And I will see you a week from Monday.
Wait.